You know, for generations, we were all sold this idea of the American dream. And right at its core was the 30-year fixed rate mortgage. It was supposed to be the bedrock of your financial life, the one thing you could count on. No matter what happened in the world, that one big expense was locked in, safe. Well, that era is over. And the feeling of security that millions of homeowners have right now, it's a dangerous illusion.
Look, that's not just some dramatic statement for effect. It's a conclusion, and it's based on contracts that are already signed and dates that are literally set in stone. There's this quiet mathematical certainty that's just barreling towards the housing market, and it has nothing to do with the day-to-day chatter about prices. No, this is about a structural reset. It's been years in the making, and it's about to begin.
And this number is the key to understanding everything that's coming. At a bare minimum, $1.5 trillion of residential debt is contractually scheduled to reprice by March of 2026. This is not a forecast, okay? It's not some bearish prediction. It's an event that is already locked in, a financial trigger that's just waiting to be pulled. The only question now is what happens when that bill finally comes due.
Welcome to Bullion Signal. You know, our whole mission here is pretty simple. We help you filter out all the market noise and just focus on the clear, actionable signal. If you want to understand the deep mechanics that are really driving the economy and your own wealth, take a second to subscribe. We're really glad to have you as part of our growing community of clear-eyed analysts.
Okay, so to really get what this reset is all about, we have to rewind a bit. We've got to go back to the scene of the crime, the pandemic housing boom of 2020 and 2021. I mean, think about it. The Federal Reserve had interest rates pinned down to zero, stimulus money was flooding the system, and this speculative fever just took over. Prices went vertical, pushing affordability out of reach for millions. And to bridge that gap, well, the banking industry revived a very familiar and very dangerous tool.
Yeah, they dusted off the old adjustable rate mortgages, or ARMs, and home equity lines of credit, HELOCs. But here's the twist this time around. They weren't just for subprime borrowers. Oh no, they were sold to prime borrowers, doctors, lawyers, engineers, people with fantastic credit scores. The pitch was so simple. Hey, just take this low teaser rate for 5 years, and you can refinance before it ever resets. And millions of people took the bait, taking on huge amounts of debt at the absolute peak of the market. And that brings us right to the first pillar of this crisis, the trap that was so meticulously set for the individual homeowner. And look, this isn't about blaming people for making a bad decision. It's about understanding a financial environment that basically incentivized millions of people to walk straight into a snare that is now just about to snap shut. Just look at the simple, brutal math on this timeline. A common 5/1 ARM taken out back in early 2021, well, it had a fixed rate for 5 years. That 5-year clock runs out in early 2026. And while those homeowners were enjoying their low payments, the Federal Reserve launched the most aggressive rate hiking cycle in modern history. The gap between their original teaser rate and today's market rate, well, it's the widest it has been in 40 years. Let's make this real. I mean, painfully real. Imagine the Smiths, a family who bought their home right at the peak. When their loan resets, their monthly payment could easily jump by $1,500. That's $18,000 a year, just gone from their budget. This is what we call payment shock. And with savings already wiped out by inflation and credit card debt at all-time highs, for most families, that extra $18,000 simply doesn't exist. Now, the obvious answer is to just sell the house, right? Well, not this time. This is a perfect textbook example of the prisoner's dilemma we call the lock-in effect. See, if they tried to buy even a smaller, cheaper home, they'd need a new mortgage at today's punishingly high rates. The monthly payment on that smaller house, it would be almost the same as their reset payment on the bigger one. They are financially trapped in a home they can no longer afford. There's no way out. I want you to really think about that. When a family is trapped like this, the mortgage is the absolute last payment they miss. They will cut everything else first. They stop eating out,
They cancel the vacation, they put off fixing the car, they'll default on every other loan they have. This means the housing crisis is going to act like a vampire, slowly draining the lifeblood out of the consumer economy long before the first foreclosure sign ever even appears on a lawn.
But it's not just individual homeowners feeling the squeeze. The big players, they're also making their moves. And this is where the story gets really interesting. Because the smartest money in the room, the institutional whales like Blackstone, they're not panicking. Not at all. They're strategically and quietly heading for the exits. To understand why, you have to stop thinking of houses as homes and start seeing them for what they are to these guys, purely financial assets.
For a decade, cheap debt basically created an infinite money glitch for these giant firms. But just look at this chart. Today, the risk-free rate on a U.S. Treasury bill is over 5%. So, why would a Wall Street fund deal with tenants and taxes and leaky roofs for a 5% return when they can get a higher return from government bonds with literally zero risk and zero effort? It's a no-brainer. The choice is obvious.
These whales are way too smart to just dump tens of thousands of homes on the market and crash prices. No, instead, they're executing a slow bleed. They're selling through private channels, they're offloading entire portfolios to smaller investors, and they're listing homes one by one so they just blend in with regular sales. They are quietly cashing out at the top, and in the process, they're systematically handing the bag of risk over to individual investors who still believe the market only goes up. And this selling pressure, it's not just coming from the mega funds. It's also connected to that other crisis we've been hearing about in commercial real estate. See, the very same regional banks that are drowning in bad loans on empty office towers, they're also the main lenders to mid-sized real estate investors. And as these banks fight for their own survival, they're cutting credit lines. That forces those smaller investors, the folks who own maybe 50 or 100 homes, to sell their portfolios to pay back the bank. It's all connected.
So let's just pause here for a second. The trap is set for the borrower who's about to face a massive payment shock. And the smart money, the whales, they're already leaving the building. Now, those two forces alone are a recipe for a pretty severe correction. But there is a third, unavoidable force, a systemic failure happening completely outside of interest rates that makes this time truly different. In part 2, we are going to reveal the insurance death spiral and outline the shelter protocol for surviving what's coming.
Welcome back to part 2. As our growing community here at Bullion Signal already knows, understanding the mechanics of a problem is really only half the battle. Now we're going to connect that final critical dot and outline a clear framework for navigating the storm ahead. If you happen to miss part 1, don't worry, the link is right down there in the description for you.
All right, to get you right back up to speed, in part 1, we established the borrower's trap, where at least $1.5 trillion in adjustable rate mortgages are contractually set to reset at much higher rates, starting around March of 2026. Then, we uncovered the whale's exit, as these large institutional investors are now financially incentivized to sell real estate and just buy risk-free bonds. These two forces are creating a perfect storm of selling pressure.
Okay, now we have to talk about the third and final pillar. And frankly, this might be the most destructive of them all. This is the insurance death spiral, a systemic crisis that has absolutely nothing to do with the Fed or Wall Street or mortgage rates. No, this is about physical risk, and it is a slow-motion demolition of property value in entire regions of the country. Here's how this chain reaction works. It starts with the global reinsurers. These are the huge companies that insure the insurance companies. Well, they're pulling out of high-risk states like Florida, California, and Louisiana because of climate-related losses. This forces your primary insurer, like State Farm or Allstate, to either double or triple your premiums or just stop writing new policies altogether in your area. This is already happening to millions of people. And this is the trigger that turns an insurance problem into a foreclosure crisis. See, if a homeowner loses their insurance policy, the terms of their mortgage allow the bank to buy a new policy for them. It's called force-placed insurance, and it is brutally expensive. We're talking 3 to 4 times the normal rate. All of a sudden, a family can see their monthly housing costs jump by thousands, pushing them straight into default, even if their mortgage rate never changed one bit.
So the bottom line is this. If a home becomes uninsurable, it cannot be financed with a traditional mortgage, period. No bank will ever lend against an unprotected asset. This means the property can only be sold to an all-cash buyer who is going to demand a catastrophic discount. The home becomes a toxic asset. And when that happens, it doesn't just destroy one family's equity. It craters the property values for the entire neighborhood. And the spiral just gets faster and faster.
So, we've laid out the 3 pillars of a coming reset. The evidence really points to a significant and prolonged market correction. And the immediate question becomes, how do you protect yourself? This brings us to what we call the shelter protocol. And I need to be crystal clear here. This is a framework for thinking about risk. It is not certified financial advice.
The protocol has 4 core rules. Rule 1, for current owners who have equity but are feeling their cash flow tighten, consider a strategic exit now, before the market gets flooded with distressed sellers. Rule 2, if you can't or won't sell, you must neutralize your variable debt. Refinance out of those ARMs and HELOCs now. Rule 3, for anyone looking to buy, just be patient. Renting is cheaper than owning in most major markets right now. And Rule 4, adopt the vulture stance. Build up your cash reserves so you can acquire distressed assets when the real opportunity arrives in 2026 and 2027.
As we've seen, these risks aren't the same everywhere. They show up differently all across the country. So I want to ask you, looking at your own city or neighborhood, what is the single biggest risk you see right now? Is it the insurance costs? Is it just pure affordability? Or is it something else entirely? Share your on-the-ground perspective in the comments below. We all learn from each other.
At the very beginning of this, we talked about that reset coming in March 2026. Now we can see the full picture. The mortgage resets, the institutional exit, and the insurance crisis, they are all converging into a powerful deflationary credit crunch. And in that kind of environment, there is only one golden rule. The single most important takeaway from this entire analysis is this: cash is king. The person holding liquid cash will be the master of this market. Let me just end on this note. This isn't speculation. It's not fear-mongering. The mechanism for this housing reset is already locked in place. The loan documents have been signed, the insurance carriers are already pulling out, and the dates are fixed on the calendar. This is a story about math, not about market sentiment. And your job is to understand these forces so that you and your family do not become collateral damage.
And of course, all content here on Bullion Signal is for informational purposes only and should not be considered financial advice. We strongly encourage you to consult with a qualified professional who really understands your specific situation before you make any major financial decisions. Thank you for your time and for your attention.